Let's get our market master in today. Nilesh, Shah-MD and CEO of Axis Capital, joins us from the sidelines of the Axis Capital India Conference 2014. Hi Nilesh, good to see you, and as always, what's your view on the market now? We've seen, last week that was spent in profit booking. Is it just that, or are investors turning a bit cautious now at higher levels?
I think we have to look at market on a longer term perspective rather than on shorter term perspective. Till now, our markets have run up, say, between 2008 to 2014, more on FII flows. The Sensex is virtually plus or minus 10% during that period, but the earnings have almost doubled. So your valuations have halved, and valuations are in your favor. The domestic ownership of equity is at all-time low level. From here onwards, we think it's not only the FII flows, but also the domestic flows which will turn positive. And this is going to create a multi-year bull run in the equity market. Surely there will be correction in the short term, but over a period of time, we think equity is at a stage where it will be in a multi-year bull run, and investors should get adjusted to this market where it's a buy on dip market.
Well, so if you are predicting a multi-year bull run, Nilesh, should investors shift from gold, bonds and other assets into equities?
So the investors have to do their asset allocation, but clearly this is the time to be underweight gold. Gold, we have been negative for a long period of time, and this is one of the few calls where we have become right all the way. Even today, the import premium which is there, the import duty which is there, that's clearly make gold an unviable investment. The second thing is in terms of bond, interest rates have not declined on the policy side, but on the market side, and which has really given decent return to the bond investors in the short term. However, over a period of time, we think if we see risk-adjusted return, then certainly equities is likely to outperform bond by a reasonable margin, and hence this is the time to be overweight equities, neutral bond and underweight gold.
All right. You must have met a lot of investors over the last 2 days or last week at your conference, Nilesh. I know this question is a no-brainer, but what's the mood towards India now?
I think we had almost 40 institutional investors participating in our London conference. And majority of them were looking forward with optimism to the new government formation. Clearly, India is at the top of the radar. They are watching how the economy will pick up, how growth will pick up, how investment revival will occur. And a lot of them are focused on bottom-up ideas. So from an FII point of view, clearly one can expect that for the rest of the year, we should receive decent inflows. More importantly, if we see India vis-a-vis other emerging markets, in Russia today, FII is on the back foot because of the Ukraine crisis. In China, there are concerns related to credit growth and credit bubble, and the economic growth slowing down consequently. In Brazil, the macroeconomic fundamentals are fairly weak. In Turkey, Thailand, and Indonesia, there are political concerns. So within emerging market today, because of the decisive mandate, India looks attractive, and most of the investors who participated in our conference, they're looking forward to India with the optimism.
Okay, Nilesh, you've had a few banks attending your conference. What's your view on private and PSU banks?
So our view is that the private sector banks are going to outperform public sector banks. Private sector banks is more of a long-term investment. Public sector bank is more of a short-term trading. The valuations in PSU banks were highly depressed, and hence they have bounced back. And now one has to be selective. Obviously, there will be few public sector banks which will do very well, and one will have to be fairly selective in picking up those public sector banks. Those PSU banks where the tenure of the chairman is fairly long, that's probably one indicator to differentiate one PSU bank versus another PSU bank. In the private sector banks and NBFCs, we prefer slightly, cheaply valued private sector banks rather than more expensively valued private sector banks, because we believe this valuation gap will continue to narrow. This trade we have been recommending for some time, and it has worked well till now, and we still think that there is some more room to go in this kind of trade.
Well, just talking a little more about some of these banks. Yes Bank raised what, $500 million via the QIP issue. Do you think there is enough appetite for the financial sector stocks amongst investors?
I suppose so. Banking sector today is more than quarter of the market capitalization. Banking sector normally grows at a multiple time GDP growth. Most of the time it even outperforms the nominal GDP growth. The regulation in Indian banking system has been fairly fantastic and robust. It's been proven during the crisis of 2008, and the opportunity in terms of growth is fairly high. So you put all these things together vis-a-vis some of the banking stocks in emerging market world, Indian banks, Indian financial system definitely provides an attractive investment opportunity. And we believe there will be enough investor appetite to absorb the potential supply which could emerge from both public sector as well as private sector enterprises.
Okay, what's your view on IT stocks? Actually, Infosys in particular, it cracked 8% after the Srinivas quitting news, but is seen buying now. So should this low be seen as a buying opportunity?
So clearly in the near term, IT sector will continue to remain under pressure because of appreciation of currency. However, with every dip in the IT sector prices, it's becoming more and more attractive. Most of the mid-cap IT companies are available between 8 to 12 times forward earning, and most of the large-cap IT companies are available between 13 to 18 times forward earning. These are good quality businesses. They generate free cash flow. They are unlikely to dilute their capital, and the growth, while in the near-term pressure because of currency, will continue to grow over a period of time. So if you are a value investor, this is the time to accumulate IT sector without expecting near-term return. But if you can average yourself in over the next 6 to 8 months, I'm sure on a 3-year horizon, that will be a great investment.
So this is the time to accumulate the IT sector, perhaps on cue, Nilesh, because a lot of the IT stocks are seeing buying action this morning. But what are the other sectors that you think are good to buy on a dip?
So another sector which we are bullish upon is the pharmaceutical sector, which is again coming under pressure because of the currency appreciation. Now within this, you have certain pharma stocks which are available at an extremely attractive valuation. And again, in the near term, this stocks and this sector is likely to underperform. But if you have a longer term horizon and you can average yourself in over the next 6 to 8 months, then that investment also will be as rewarding as the IT sector. Essentially, this whole market today is giving you an opportunity whether you're chasing the long-term return or whether you're chasing the short-term return. If you're chasing long-term return, then you have opportunity to average yourself into sectors like IT and pharma. If you're chasing long-term return, short-term return, then small, mid-caps, PSUs, and the cyclicals provide great opportunity.
Okay, any sector you think investors should avoid at current levels?
More than the sector, I think it's worth avoiding those companies which are extremely leveraged. It's worth avoiding those companies where promoters have taken corporate governance for granted. It's worth avoiding those sectors where the projects are under construction and they are unlikely to materialize in near term. So avoid leverage companies, avoid debatable or doubtable promoters, avoid long gestation projects. These are not the stocks which are going to give immediate return.
All right. You spoke about a multi-year bull run, Nilesh, something that most experts have been indicating. But do you have any index target in mind? What kind of return should investors expect, say, in the next 2 to 3 years?
But I think the return from here onward should be higher than what markets have provided on a historical basis of last 10, 15, 20 years. This is the market where stocks will definitely give far more return than the index, but overall index should be in a position to outperform the other form of investments like the fixed income or the gold.
Okay. All right, Nilesh, as always, pleasure speaking with you. Thank you very much for joining us.